there's an opportunity cost to working too long. If you're already well off and you have a pretty sufficient or even a more than sufficient nest egg, so now your opportunity cost works the other way around, right? Every year you keep working, you lose the time to spend with family or travel while you're young and still healthy.
Welcome to Redefine Retirement with Ryan Wheless, powered by Allied Wealth. This podcast explores how to live a limitless life of abundance in retirement with clarity, purpose, and confidence. Hey, Ryan Wheless here with Redefining Retirement. I'm excited to welcome Karsten Jeske, aka Big Ern, the mind behind Early Retirement Now. With a PhD in economics, a CFA designation, and experience at the Federal Reserve and Bank of New York Mellon, Karsten shares proven strategies on a safe withdrawal rates and financial independence. This is an episode you don't want to miss. Welcome, Karsten. You're known as Big Ern.
Right.
Where did that come from?
It was a nickname, and I like the nickname because I was anonymous initially. So I was still working for BNY Mellon, and I started the blog in 2016. And if you're working for a big corporation, right, you don't want to signal to your employer that you're on your way out and you're planning to retire in 2 years, right? You still want to have bonuses and promotions. And so then somebody gave me the nickname Big Ern, right? So ERN, early retirement. Now it's Ern. So Big Ern. I'm a big guy, so I'm 6'6", 200 pounds. So,
oh, wow.
So I thought that was very fitting. So, and it stuck.
That's awesome. So you were at Bank of New York Mellon. What did you do there at BNY?
So Bank of New York Mellon is one of the largest asset managers worldwide. I think it's at the top 10. And they have several smaller boutique asset managers. And I was at a place called Mellon Capital, as it was called back then. Now, they have gone through some corporate mergers and stuff where they put certain units together. It might be called different now, but back then it was called Mellon Capital Management. And we would do asset management for large institutions. So pension funds, endowments, sovereign wealth funds would be our typical clients. And I was in the global asset allocation group. So not stock picking, but essentially market picking. So are we more optimistic on US stocks versus German stocks versus Canadian stocks? Then also stock versus bond versus cash. So that was a big business for us. So tactical asset allocation. And so we did the research and it's basically wrote the programs and the prototypes and the models behind that. So this wasn't done in any way discretionarily. It was done completely model based. So very exciting because it merges macroeconomics with finance. So I always found that very exciting.
Right. So you've been deep inside of money management for large institutions, right?
Right. Yeah.
Interesting. You know, I've often heard that endowment funds if there was like a world championship heavyweight belt of investing and return wise, I've always heard that endowment funds would lead that. Do you think that's accurate, or would be the champions of steady, consistent returns over time?
Well, I mean, you obviously hear about it's a bit of a selection bias, right? You hear about the very successful ones, and they obviously have access to some private investments that not everybody has access to. And then obviously, because they are into private investments, they look like they're smoothing out their returns, which they don't really. It's mostly because you don't see the volatility. But yeah, I mean, obviously, yeah, I mean, endowments are a big force in the asset management world. And then also, I mean, the nice thing is the people that you talk to, that you're trying to sell something. I mean, they are basically just as well educated and well experienced. And the only reason really why they talk to you is that certain things they can't do in-house. So they outsource that. And this is why they would talk to us. But yeah, it's very hard to get your foot in the door because you're talking to real experts, like-minded people. So it was it was a fun job that I had for 10 years there.
That's awesome. And so you left there and actually you started your blog while you were working there, and you left there to do your blogging full time. And is that kind of the path you took?
No. I mean, I don't do my blogging full time. So I just do this as a hobby. And I have obviously published a lot less now that I'm in retirement than when I was even working. So it's amazing because, retirement is too much fun. I like to travel a lot. I travel about 12 weeks or so per year. It's not all at once, right? Spread around a little bit, because we have to keep in mind our daughter's school breaks and stuff. So, but we travel a lot. And then we also volunteer a lot at school, at church. So my wife and I, it's maybe not a full-time job, but it's almost a part-time job to chauffeur around our daughter to after-school activities. And we do some of the coaching. My wife does the coaching for the robotics team. I do the coaching for the mathematics team at school. And it takes some of your time too.
How old are your kids?
I have one daughter, and she's 11 years old, almost 12. So she's in 6th grade, first year of middle school here. So
I've got a 6-year-old and an 8-year-old, and I know all too well about carting around after school and all that sort of thing. Yeah, it's a lot. Now, I'm not retired yet. I don't know what I would do other than go stir crazy and play golf every day. But we're dealing with the same thing about carting around after school. One's got cheer, one's got golf, one's got baseball, the other one's in golf as well. So, it's pretty interesting. Well, you guys seem to have retired pretty early in life, right? Is that, am I understanding that you retired about 44?
So I was 44. My wife was 35 and haven't had a W-2 job after that. But again, so you pick up other stuff after you retire, right? So I do my blog part-time. I have now my own investment advisory business. So I'm fully registered, the whole thing. So I sometimes do some one-on-one consulting, so hourly advice for safe withdrawal rate planning. And then I even have a little bit of AUM business. So that option strategy that I developed, I took on a very small number of clients, so high net worth individuals, and I run that strategy in separately managed accounts for them. And do a little bit of that, get a little bit of AUM fee from that. So it's obviously amazing, right? You think you're retired, and then opportunities come up, and you can make a little bit of extra money on the side. If I had zero money in the bank and I had only that income, it would not be enough, or it would be enough for some retirement lifestyle, but not the one that we would prefer. But it's nice to have that little bit of extra cash flow there. So
yeah. Interesting. So your strategies, are you writing options and that sort of thing? Are you trying to, okay. So how do you help me understand that? I mean, how do you take somebody that wants to retire early and kind of has no experience writing options and that sort of thing and kind of guide them to say, hey, this is something you can do. You might be able to retire earlier than expected and define your risk with options, which you can obviously do. I mean,
so, this is obviously only for highly sophisticated investors, right? So, this is usually, so at least the strategy that I do, because people can do things like covered call writing and things like that. And, so that's actually effectively less risky than holding the underlying, right? So because you sell an at the money option, and you have actually only a delta of 0.5 instead of 1 of having just the underlying. So that is actually less risky. So you can structure option trading, obviously, to even reduce risk and have some extra income potentially. Now what I'm doing is obviously is the other side of the spectrum, right? This is what people tell you not to do. So it's naked put writing, naked call writing. So you have to have some risk model. You have to have, risk controlled stop loss orders and things like that. And, so normally I've been running this for, I think now 14 plus years.
Oh, wow.
And I've been through a lot of volatility, and I've done some back testing and how would it have done, say, during the Lehman failure. And I actually did phenomenally well in March of 2020 because volatility was so high, right? You're selling insurance, and people would pay you for insurance at absolutely insane rates. And again, recently in April, it worked out roughly the same way again. So I think it's actually a pretty neat strategy. And the nice thing is that you can do this on top of an existing portfolio. Right. So I don't have to sell any of my underlying assets, and then buy an ETF and then have somebody else, run this. So you can do this on top of your existing portfolio, which serves as your collateral. And then you can trade, some options on top on margin and squeeze out, somewhere, depending on how you scale it, 3, 4, 5% extra return per year, which doesn't sound like much, right? So think about even somebody with zero risk portfolio is already making 4% with T-bills. And then you add another 4% with a very smooth returns, relatively low risk. I have an information ratio of somewhere about 3. So 3 times. So you don't use a Sharpe ratio, you use an information ratio for that, right? Because it's an alpha strategy. You don't have to subtract any cash returns. It's already an alpha. So you have 3 times, returns are 3 times higher than annualized risk. So, which is pretty phenomenal. And so you put this on top of your portfolio. And I mean, you think about it. This is not suitable for, say, the YouTube influencers, right? That start with $5,000 and they are looking for the 100% extra return, which is also highly risky. But what I do is basically for people with 7-figure taxable accounts. And they just want to trickle out a little bit of extra return. And so that's what I do.
That's awesome. And to be able to do that for somebody too and have the opportunity to serve in that capacity is, there's nothing better. I mean, everyone's looking for a smooth, 6-8% return. You get a 4% withdrawal rate, 5% withdrawal rate. You're fighting inflation, covering fees and that sort of thing as well. And if you got smooth volatility, that helps people stay committed to their long-term plan, which I think is important, especially for someone following your advice, because you're kind of a fan of retiring early, right? I mean, that's kind of your thing is retire now and retire early.
Yes, because obviously, there's an opportunity cost to working too long, right? So when we are teaching economics, right, we usually teach opportunity cost the other way around, right? We teach that if you go out and have fun, you have the opportunity cost of not being able to work, right? So if you go to the movie theater as a student, you have the direct cost, and then the indirect cost is that you can't do a gig and make money on the side. So that's the opportunity cost. And that's the opportunity cost if you are poor and you don't have any money. If you're already well off and you have a pretty sufficient or even a more than sufficient nest egg. So now your opportunity cost works the other way around, right? Every year you keep working, you lose the time to spend with family or travel while you're young and still healthy, right? So my wife and I, we like to travel a lot and then use different routes, and different modes of transportation. Our favorite one is cruising. And on cruise ships, obviously, we are sometimes the youngest people on the cruise ship, maybe not the youngest people, but you get the message, right? Because you see a lot of very old couples, and you can tell, right? I mean, they're having a good time, but they probably can't enjoy this cruise as much as we can, right? Because we go on land in Iceland and we do pretty rugged stuff. That somebody, say twice our age can no longer do. And, so there's the opportunity cost. Enjoy life while you can. And again, I mean, it wouldn't have been terrible if I had stayed at my job, but, I think about all the stuff that happened between 2018 and now, right? I mean, the scare during the pandemic and having to go to the office. I didn't have to do that. And, so I was able to travel. We traveled very aggressively in 2018, 2019. We were on the road for a total of 11 months. And, that was awesome that we could do all that before our daughter, went to kindergarten. And, we enjoy our time and enjoy our retired life. We have an 11-year-old daughter. And I think she has been to something like 54 or 55 different countries. So,
Karsten, that's awesome. Folks, listen to me right now. If you're not hearing anything from this podcast, that right there is what life's all about. It's about experiences. And Karsten's got a good point here, in the sense that, I see people oftentimes they're fearful, they're scared. And a lot of times people can make it on what they've got, but they're so fearful of running out of money or a market crash or something happening, they actually oversave.
Right, for sure.
And people that oversave, yeah, you can get more money, but you can't get time back. And Karsten, I'm a big believer that when it comes to the mindset of retirement, money is not the most important thing.
For sure.
Your time.
Yeah, it's your time.
And how you spend that time. And I'm a big believer that the money you have is a tool that allows you to enjoy the time you have left on God's green earth.
Yes, yes. And your portfolio can go down. It usually recovers, but the time, that is gone, right? You will never have that back. So that's a very powerful message. Yes, yes.
Yeah, it really is. So tell me this. You got some financial myths, right? I mean,
right.
What's one common myth that you want to bust here?
So I think the most dangerous one is the 4% rule, I think, right? So, and I have less of a problem with the 4% than the word rule, right? Because there is so much idiosyncrasy, so many different parameters and constraints and strengths and weaknesses that different people have. And then also across time, right? We can't have the same withdrawal rate across time. Right. So just to give you a few examples, right? So the idiosyncratic factors, right? It depends how much you want to withdraw. It depends. Well, what's your age? What's your horizon? Do you want to deplete your money? Do you want to leave a significant inheritance? Do you face any other cash flow constraints, right? Do you think you're going to have to spend time in a nursing home when you're older in retired life? And then also, so basically market parameters, right? So right now, as we are recording this, S&P 500 is at 6,600 points. The price earnings ratios, no matter what you look at, is the PE forward, PE backward looking, Shiller Cape. Everything looks wildly overvalued for the stock market. So the market valuations are extremely highly correlated with some of the retirement risk that you're going to face, right? You have a higher risk of running out of money if you're retiring at the top of a bull market than if you're retiring in, I say, March 2009 or June 1932, if we could go that far back. So market parameters and personal parameters, right? They have such a huge impact on what should be your safe withdrawal rate. And then some people obviously then also say, well, if it's 3% or 4% or 5%, well, it's only a percent difference, right? Of course it's not, because say you have $1 million portfolio, going from $30,000 to $40,000 is not a 1% difference, right? It's a 33% increase. Or
it's a big difference. Yeah.
Or going from 40 to 50, that's a 25% difference, right? The percentage point in your withdrawal rate, that's the percentage of your nest egg, of your corpus. But even small percentage changes in that safe withdrawal rate make huge impact on your retirement budget. And then you multiply that, right? So you imagine you don't have 1 million, you have $4 million. And then you look at some of the ranges of retirement budgets that you would get at 3, 4, 5, or 6%. This basically you could drive a truck through that range. This is a very large range, and is basically the difference between a very high end retirement and a very modest retirement. So it's really useful to look at some of your personal parameters and constraints, and then also at market conditions when you retire. And I mean, so right now, obviously, I would probably be a little bit more cautious, right? Because today's market condition definitely looks exactly like something like we saw in 1929 or in 2000, and maybe tread a little bit more cautiously. At the same time, I mean, bond yields are definitely now much better than they were just right around the time when I retired, right? When bond yields were in the 1 to 2% range. So that would be very unhelpful. But so now you have a little bit better conditions there. And then on top of that, right? I mean, are you an extremely early retiree? And by the way, you are still an early retiree if you retire in your mid 50s, right? That's still
that's for sure.
By the norms of American personal finance standards. That's extremely early. In the FIRE community, it looks like everybody tries to outdo each other. And so somebody retired at age 30, and then now people want to retire in their 20s. But these are really exceptions, not the norm, right? And normally, if you do retire that early, say at age 30, right, you probably, with this, say, 60-year retirement horizon, you probably shouldn't do a 4% rate. You maybe scale that down a little bit. But most retirees, say, who pull the plug in the 40s or 50s, or even late 50s, you have these special situations where, well, you have your Social Security right around the corner, right? You have pensions around the corner. You might do a downsizing of the home. So, and instead of having this traditional retirement, right, where you retire and then Social Security and your withdrawals, everything starts at the same time, you have a very different situation. You have basically a multi-stage retirement, right? So you have the stage between your retirement and when Social Security kicks in, where you have to withdraw a little bit more. And then once Social Security kicks in, you can reduce your withdrawals. And so how do you factor that in? So I've done a lot of case studies where people who are a little bit older, still early retirees, but a little bit older, I mean, they could have done something like a 5.5 or even 6% withdrawal rate, because once you factor in, two high earners, they have contributed a lot into Social Security, get close to the maximum benefits, both of them. So they can withdraw a little bit more initially, and then maybe 5, 10, 12 years into retirement, it's when your Social Security kicks in, and then you can lower your withdrawals again. And then even if you deplete your portfolio a little bit, at that point, hopefully your portfolio should then recover again and build enough of a reserve if you want to leave anything to your heirs. And so the 4% rule the 4% might be a pretty good starting point, right? If you're really far away from retirement and you say, well, I try to retire in 20 years, how much do I have to save today? And then you do some of these online calculators, and it gives you some advice on how much you have to set aside every month. And then then you can work with the 4% rule or 25x annual spending. But once you get closer to retirement, you probably want to do a bit of a more detailed analysis. And you want to check, because, and by the way, it can go both ways. And my experience is it actually goes more in the other way, where most normal early retirees, right, they can actually go higher than 4%, even if market conditions are a little bit scary and very lofty equity valuations. And the reason is always, well, you have some supplemental cash flows later in retirement once you work those in. And even if you give a little bit of a haircut to Social Security, because we don't know, are there going to be some benefit cuts at some point in the future? Might be, might be not. Even with that worked in already, normally you might actually get a higher than 4% withdrawal rate. And then on the other side, and the other end of the spectrum, you have these super early retirees, right, who are basically 40 years away from Social Security. So for them, these supplemental flows, they are probably, they're so far in the future. So net present value of that is essentially negligible. And you have a very long horizon, and it's very risky to retire so close or at the market peak. They probably want to do a little bit less, even though, of course, if you're really young, you could still also make the case, well, if things go sideways, you can always go back to work, right? And that's something you can factor in too, if you want.
And I think you're mentioning going back to work, right? I mean, no one wants to retire to go back to work. Okay. Right. But it's kind of cool, because to me, you retired, but you retired to something. Right? You had your blog, and you're very, very good with your option strategy. I mean, you're a certified financial analyst, which is the creme de la creme of designations in the financial services space, by the way, folks. And now you're running this option strategy. You're picking up a little bit of money, from that. I assume you're probably doing some similar stuff with your own money.
Right. So, exactly.
And so that's just pretty cool, because you retired to something. And I think that's a big thing for someone retiring young, is that, you're not going to stop and go sit in the lazy boy rocking chair at home. You're going to do something, right?
And so opportunities will open up, and again, it's hard to plan this and hard to guarantee it, But so chances are if you retire and you're kind of halfway certain that without any future cash flows, you're still kind of sort of okay, you should probably retire because the worst thing that can happen is that you never work a single day in your life again and you never get any consulting gig. But something will and something can and will probably come about that will assist your cash flow situation in retirement.
I think the other thing you got to think about too, Karsten, is the healthcare aspect, right? Because you got to self-insure for many, many, many years if you're going to not have a job or W-2 income or work for a company. And of course, the cost of that should go down when you reach Medicare. I mean, theoretically, right? So that's an aspect too to look at. Tell me about this. When you say, the 4% rule, and I just want to run this by you because we do some back of the paper, napkin math here. So if somebody's making $100,000 a year, and let's assume they're putting $20,000 a year into their 401k, and they've got another $2,000 a month on a mortgage. Well, if they pay the mortgage off before they retire, okay, that cost is gone. All right. And then they've got the $20,000 a year they were putting in the 401k to pay for retirement. Well, once you retire, that payment for retirement goes away. So you've gotten rid of $24,000 plus $20,000 401k contribution. You've gotten rid of $44,000 of cost, right, before you're working. And so one of the big ones that we have to teach people about is they forget that you also stop paying the payroll tax,
right,
which is 7.65%. So that's $7,650. So we're at 44 plus $7,650. We're at $51,650 less in cost that you had while you were working, right? So in essence, you should be able to live the same lifestyle you're living today on about $49,000 a year in income.
Right. And again, I hope that people do their personal analysis because there are these rules of thumbs, right, that you need a 70% replacement ratio. I have no idea where that came from. And it's also some average that might work. But again, we can't all wear size 10 shoes just because that's the average shoe size, right? It's going to be too tight and too big for others. So I think there too, looking at your budget numbers, you should do some personal and your personalized analysis, right? How much do you really need in retirement? There will be some other people who say, well, if we don't have a stressful job anymore, we don't have to commute to work anymore. We need only one car, not two. Right. We need less for work lunches and less for attire. And so all sorts of things could become cheaper in retirement, and then other things could become more expensive, right? You have more time to travel, more time for fun. So for example, I think that expenses for kids might go up before they go down, right? So it's very easy to please an 11-year-old, but at some point she'll go to college, she might develop more expensive habits for clothes and fashion and makeup and stuff like that, right? Don't forget
the car.
Don't forget the car, exactly. There might be down payment assistance, right? Paying for a wedding. And so it could get more expensive before it becomes less expensive. And some of this, you could also factor into your analysis and But at some point we'll be empty nesters, and so maybe at some point our expenses will go down from not having our daughter in the same household. So
yeah, that's interesting. So when we go back to that number, that $49,000 number, what we do at Allied Wealth, Karsten, is we would take that $49,000 and we divide it by 4%.
Right.
All right. And that'd give us $1.225 million, $1,225,000 that you would need. But then let's say you're doing that at 60. Well, guess what happens at 62?
Right.
I'm not saying you should do it at 62, but you become eligible for Social Security. So now you potentially need even less money than that. And I think that's really important because we have a retirement crisis going on in America. And I think a lot of people really don't sit down with a good financial advisor like myself or you, all right? And say, hey, listen, what is real? This 4% rule, how do I use it? This, 120% of my retirement, of my income I need to have when I retire, or 25 times my income, or, 70% of my income. How do we navigate all this stuff to really get down to what is my personal situation? What's we call it our blueprint, right? Our thumbprint, what does it look like? And it's a sea of stuff to navigate, Karsten, because, our education system in this country is really interesting to me. And the reason why I say that is they don't teach this stuff in school.
Right.
And I think there's a reason for it. I think the education system is from the era of the late 70s. And, back then people worked at a company for 30 or 40 years. They retired. They got a gold watch. They got a pension, and they got Social Security. And very few people, individuals like myself or you, or people that watch our podcast here, had any money at all in the stock market. But yet, in 1978, when the 401k plan was introduced to the Internal Revenue Code, companies started using that as a way to get away from managing retirement for employees, right? And now the onus to save for retirement was put on the employee's back through saving through the 401k plan, which, by the way, was never designed to be the primary retirement vehicle in the first place. But what didn't change is the education in the country to go, hey, you know what, guys and gals? You're going to learn about mathematics and science and English and politics and history and all this stuff in college. But for God's sakes, people, please start teaching people about investing and saving for money and retirement planning, because it's such a big unknown area out there.
Right. And I saw some of your earlier shows, right, where you showed what a difference it makes to start early, right? So you just put aside a few $100s a year at a very young age. If you miss that boat and you start later, it's every 10 years, it basically doubles or more that the amount of money you have to set aside. And yes, so one is obviously teach people to start early, and then also stick with it. Right. So I know lots of people who start and then the market has some volatility and then they stop, right? Or they pull the money out of the stock market. And so I always had this philosophy that if you had a market turmoil, right, you almost have to rewire your brain, right? Where you say, if the market is down, oh, it's great, market is on sale, I want to invest now and put everything I can, right? I do obviously the 401k. I obviously try to get the company match. And then you might actually max out your 401k and even do some taxable investments. And so if the market is down, you put money in. If the market is up, that's good too, right? So there's positive momentum. Hey, I want to ride this train too. And don't jump off the train because this is going really well and we have positive momentum, and it, cross my fingers, is going to last for a little bit. So I think and then there are people on the other side, right? They think that if the market is going up, I don't want to get in because it's too expensive. If the market is down, they don't want to get in because they're afraid of too much volatility. So you almost have to rewire your brain. How to teach that? I don't know if you can learn that out of books, or if this is something that colleges and schools should teach, or, I mean, because there's obviously a lot of free information out there on the net. And, so as I picked this up myself, and I hope I can teach that to my readers, and you teach that to your advisees. But it's definitely, there's some deficit in economic and financial education that needs to be addressed. So
yeah, it's interesting, and I wish they would change that. We teach classes all over town here in the Houston market. That's where we're based, and we do the podcast and our YouTube channel, and everything we do is really to provide education, because the old saying, they just don't teach the stuff in school, and I think they should. Let's shift gears here for a minute, but I want to go to Social Security.
Yeah.
You mentioned it a few minutes ago, and then I'll spend a little time on taxes, and then we'll go into some alternative investments, because I've got some questions on that, if you don't mind. But let's talk about Social Security. What are your thoughts? Should I take it at 62? Should I take it at 67? Should I wait till 70? I got to get it all right now because the government's going to go broke, and there's not going to be any Social Security left for me. As an advisor, we hear all kinds of different, thought processes on when to claim benefits. I mean, what's your takeaway and some thoughts?
So my takeaway is that usually people should wait and max out Social Security. First of all, for married couples, there is definitely a bit of a way to hack Social Security, right? So there's the joint claiming strategy where, and I'm not saying that this is applicable to 100% of households, but in my personal household, so I'm a little bit older than my wife, and I have higher Social Security earnings than my wife. So what we are going to do is I'm going to defer my Social Security until age 70. And my wife claims as early as she can at 62. And of course, chances are, and this is just how demographics work, that my wife, first of all, as a woman, she has a longer life expectancy. And then you add also our age difference. So chances are that I die before her, and then she can take over my benefits. And then basically toss her benefits. And then basically her benefits are, in that sense, a throwaway, right? So this is why she would claim it probably as early as possible. Because otherwise, obviously, healthy individuals that are healthier than the U.S. average, especially women, definitely get a positive expected return out of Social Security if they wait a little bit longer. But so especially in joint claiming strategies, is usually the higher earner waits the longest, and then the lower earner and the younger person claims a little bit earlier. And so if you calculate the expected lifetime benefits, that would optimize your benefits. And there are actually free tools. I think it's called opensocialsecurity.com or .org. So you plug in your numbers and it maximizes your lifetime flows. And it also goes together, right? Because so one is if you look at Social Security in isolation, right? And you just want to maximize your discounted lifetime benefit. That's what that tool does. But it would also work well together, say, with a safe withdrawal rate analysis, right? Because why do people run out of money in retirement? People don't run out of money in retirement because returns are really bad and they retire at 60, they die at 70, and they ran out of money before that. Usually running out of money, even under the traditional 4% rule, it normally happens in something like year 26 or 27 or 28, right? So, the running out of money is tied to longevity, and maximizing Social Security annual benefits is a hedge against longevity. And then, of course, if you die earlier and you leave money on the table for Social Security, well, in that case, you leave a huge pile of money to your heirs. So it's in some way, it's basically the two risks. They cancel each other out in that sense. And then if your portfolio doesn't perform so well, then you're lucky and happy that you have the maximum Social Security benefits later in retirement, and you probably don't need much of your portfolio when you're 80 and 90. So in that sense, most people will probably benefit from deferring Social Security, especially, I think there's a little bit of a selection bias, right? The people that come talk to you, the people that come talk to me, they might not be the average American, to which this Social Security actuarial exercise is calibrated, right? We are likely going to be healthier and have longer life expectancy, right? So that also adds to that. Of course, if you know that you have some health problems and you know that you have a much shorter life expectancy than the average American, sure, there could be special situation, claim as early as possible. I also don't quite buy the story that because of political uncertainty, that you should claim as early as possible. And I think that I don't think politicians are going to be stupid enough to do something like a rug pull where they cancel benefits of existing retirees. Normally,
because the people who vote, Karsten, they're all on Social Security.
Exactly. So they are, first of all, they are a very big demographic group, and they also have higher percentage of registered voters, right? So they tend to go vote more frequently than very young people. So I think, so I'm 51 right now, and my personal cutoff is, I believe, age 55. I think if you're age 55 and older, and there's any kind of Social Security reform, I don't think that, first of all, they're not going to cut benefits of existing beneficiaries.
No, that won't happen.
And then they can't even do a rug pull from people that are even say 55 and over. So normally what they do is some kind of a sliding scale where if you are born after a certain age, then for every year that you are younger, you lose another little percentage of your benefits, or they raise your your normal retirement age, say from 67 by a month for every year that you are younger than a certain age. And that normally happens for a relatively young cohort. So you stick it to the young people and you leave unfortunately your constituents, and the very likely voters might be safe in that sense. So in that sense, in 4 years, right? So the new president in 2028, and no matter who it is, I don't think the first thing out of that administration is going to be Social Security reform. I think they will definitely, if I had to hedge it, they will probably delay this for a little bit longer. And the reason why they delay it a little bit longer is that it's basically any kind of deficit. It will come out of the general revenue from the federal treasury anyways. And which in some way it is already, right? Because people say that, oh, wow, we have this Social Security trust fund, which will run out at a certain time. And but the trust fund is basically just the government is lending from each other, right? Borrowing and it's basically Peter robbing Peter to pay Paul. And if we are running deficits already, which we are, right? So basically the government has to cover the difference out of just general revenue, whether there's a trust fund or not, because this is just basically just the government is borrowing from itself. If the trust fund runs out, it doesn't mean that minute or that month or that year that suddenly we have this great shortfall where the government can't pay it. They're going to pay it exactly with the same way they paid it before. They pay the difference out of the general revenue. And of course, the shortfalls are going to become bigger and bigger. So at some point, something has to move. But I would personally be shocked if even in 10 years we have any kind of major reform, because even if the trust fund is depleted, then they're going to do, we're going to do what we always do. We're just going to issue debt, and which basically paying down the bonds in the trust fund is the same thing as issuing more debt, right? So it says money is fungible in that sense. So there's nothing really special about the time when the trust fund is depleted. It's not like we're not going to hit a wall. There's no discontinuity from any kind of financial or accounting point of view or economic or financial point of view. So I cross my fingers that we're going to muddle through this a little bit longer. And if there are any reforms, there will basically be the burden will be on the young, and which is another reason, maybe leave a little bit of an inheritance to your kids, because they will need it, right? So
yeah, as my friend Ed Slott says, do that in the form of life insurance, though, because the tax rates are going to be really high, especially on inherited IRAs. Which let's jump into taxes. Right.
Right.
We're sitting here talking about unfunded Social Security liabilities, unfunded Medicare, Medicaid liabilities. I can go on for days about unfunded. But the reality is, we're in one of the third best tax regimes in history, I believe. And the Affordable Jobs Act, known as the Trump tax cuts, are permanent, and nothing is ever permanent on the Hill, as you well know. But what are your thoughts on taxes? We're taught to save in a 401k, get a tax deduction going in, get tax-free growth during the interim. And then once we're 59.5 years of age, we can access our 401k funds without penalty, IRA funds without penalty, but we've got to pay tax on every dollar that comes out. And so the majority of Americans out there, the large majority, have saved the money they're going to use to finance their lifestyle and retirement in these tax-infested retirement accounts. What are your thoughts on that?
Yeah. So first of all, the way I think about it is that if I look at my net worth number, I basically view my net worth as, yes, I don't own 100% of my net worth, right? So probably somewhere between 5 to 20% of that money is really actually owned by the government. And it's almost like the government is a shareholder in my net worth.
Or a business partner.
Or a business partner, right? So, and they are a business partner, and they will claim eventually anywhere between 5 to maybe 20% of all that money when it comes out. Now there is obviously the way. So for example, taxable accounts, right? If the step-up basis stays the way it is, right? So you can leave appreciated assets to your heirs. And then you get the step-up basis. So essentially all the capital gains will be forgiven, and our daughter will inherit assets that are highly appreciated. So some Fidelity mutual funds that I bought in March of 2009 when the S&P was at 660 points or something like that. So she will inherit that, and hopefully the step-up basis is still there. But as you say, right? So IRAs, at some point the government wants to get the tax revenue from that. And I mean, but again, we are obviously in a very preferential environment where if you think about how much a married couple can make and still pay relatively little in taxes, right? So you live in Texas, you don't have state
about $150,000.
And I live in Washington State, where we don't have a state income tax. And so you only, quote unquote, pay the federal part. So, but a married couple can earn somewhere around $30,000 and fill up the standard deduction, right? And then you can earn another several $1,000s at 10% marginal, and then I think up to about $90,000 where you're hitting the 12%, where the 12% becomes a 22%. So you can make quite a bit of money, and you still pay only a maximum of 12% marginal, which is effectively something like, maybe if you average it over the 12% and the 10% and the 0%, you're actually a little bit below 10% effective tax rate. So if you could, in retirement, stay within this middle class lifestyle, and you realize only about $120,000 in IRA distributions, or part of it might actually be maybe you have only $60,000 in IRA distributions, and then $60,000 in long-term capital gains, right? Because remember, the 0% tax rate for long-term capital gains also is right around that same upper limit. So it's also about $120,000 in total income. So you can definitely model through retirement and pay relatively little in taxes. So that's I think we are in a very fortunate situation where so it's not every country is like that, right? And I always have to roll my eyes when people say in the US, I have to look elsewhere and I want to leave the country and find a better tax environment. I came from Germany, right? So in Germany, you have I think you have a 40+% marginal tax rate, but that top bracket that kicks in at something like 60,000 euros a year income, right? So yeah, our top brackets, they come in at, you have to be in the hundreds of thousands, something like $700,000 for federal, for married filing jointly. So we are definitely in a pretty preferential and blessed environment here. So, but I definitely agree that you should try to optimize your taxes any way you can. And so, but I also have the impression sometimes people overdo it, where they say, I mean, I know people who, when they were still working and living in a high tax state like Minnesota or Oregon, and they did Roth conversions, and they said, no, I just want to get it done and just get it out of the way. So you don't want to overdo your Roth conversions, where then later in retirement, everything is Roth and you can't even fill up your standard deduction anymore. Then you went too far.
You're giving money away for free at that
exactly.
point.
So this is really and this is where you need planners, right? So, and you're probably more of a full service planner. I don't really get into that when people ask me for advice. I can give some general advice. So my general advice is you want to equalize your marginal tax rate throughout your retirement, right? You don't want to be in the 30-something% tax bracket in one year and then the 10% bracket in another year. So you basically, in that case, you want to squeeze the the higher marginal tax rate, bring that down and shift some money into another year. So general rule is try to see what is your average spending in retirement. What do you expect out of your different accounts? This much out of Roth IRAs. Okay, that's great. That's tax free. And then, definitely try to fill up your standard deduction, probably even the 10% tax bracket with other income. And then, for example, if you haven't claimed Social Security yet, right? I mean, that would be a good time to do some Roth conversions, right? To fill up that lowest, the 0% and the 10% bracket. And then that would also take away the need, to get, the required minimum distributions and, because that might bite you in the end, during retirement. If you have too much money in tax deferred accounts where you have to do the RMDs later, and that might actually push you into higher tax brackets. It might, in the worst case, and this is definitely when you notice that you might have misplanned that a little bit, if your RMDs are higher than your actual retirement budget, right? Because that question sometimes comes up, right? Where, what do I do if my RMDs are higher than my retirement? But of course you could spend it. Of course, if you have a bequest motive, then, you take that money, put it into a taxable account, let that grow. And then at least in terms of estate tax plan, estate tax planning is something different, but in terms of the multi-generational tax plan, it is actually pretty smart, because then with a step up basis, you could, at least give some money to your kids, in a very tax advantaged way. And then maybe also, later in retirement, right? Maybe our daughter becomes a real high earner, and my wife and I, we're sitting there and we have to do the RMDs, and we might actually pay lower marginal tax rate on our RMDs than she would have to pay if she inherits an IRA and she has to liquidate this over the first 10 years. It could be a blessing in disguise to do a lot of RMDs.
My dad's a retired airline pilot from United Airlines, and he's done well. And we've had a conversation recently that, Dad, when it comes time, I'm going to pay the tax on your Roth IRA conversions. He's like, what do you mean, son? Why would you pay the tax on my Roth IRA conversions? I'm like, Dad, I'll show you the math.
Right.
I'll be glad to pay them at your tax rate for sure.
Exactly.
You know?
Yeah.
So, Karsten, let me switch gears quickly. We're going to run out of time, so I got to cut it short here in about 6 minutes. Quickly, what's your take on private credit? It's something that we're talking a lot about. It's becoming more mainstream with the pipes and the plumbing kind of being there that weren't there before. Give me a quick, take on private credit.
I haven't used it. And of course, there are different platforms. And I can't say that I can speak with any kind of authority on that. So I'm using a few private vehicles for when that's actually useful. I'm using private equity funds for real estate, but I've never done private credit. So of course you get a yield spread. And if you do your math right and you do your due diligence right, you probably can get more income than you would get with, say, a bond fund or your high yield fund. But yeah, I can't really recommend any.
It's interesting because there's been a large push on the retail side of the space, especially for RIAs such as myself. Private equity, private credit, private real estate funds are becoming more and more mainstream. It's interesting you're using private real estate and private equity yourself. And the mark-to-market rules on private equity is they're not priced on a daily basis like equities. So you ultimately smooth out the volatility curve. And if you can smooth out the volatility curve, you smooth out the emotion curve. And that's a big, big thing to manage.
Right. Yeah. So I agree that might make you sleep better. So I also view this with a little bit of concern, some of this private equity that is now being pushed into 401k. So it makes you wonder, because some of the big, say, endowments, they are probably trying to limit their private equity exposure. So do we now push stuff that nobody else wants anymore onto the retail client? So that is all, because I used to work in this space, and I noticed that certain flavors that were the big thing when I used to work in asset management, that have gone out of favor for large asset managers, that are now being pushed onto retail clients. And then they also, is always done with an aura of, this is something really exclusive. Only the really smart people have access to this, and only the highest tier clients at Goldman Sachs would usually would get the offer to participate in this. So I would so obviously there are certain special situations. I think that if you want to invest in something like large multifamily real estate, right? I don't want to do that myself because it's too lumpy. And I don't think that REITs are very good to get access to that with the appropriate expected returns. So there's definitely something to where you want to do a private real estate through a private investment. I don't think I want to do private equity just for the purpose of doing private stuff. So I would probably caution that the most retail investors might not like the final outcome, because there are cases right here. Yeah, it's very smooth, and then it blows up, and then it goes to zero. There have been cases like that. So, but yeah, it would take a lot of due diligence, and so I don't know if the average retail investor wants to do that, but I wish everybody good luck.
Well, that'll do it for today, Karsten. I can't thank you enough for joining us. Just a world of knowledge. I would love to invite you back on. I'm sure not you and I could chop it up for another 2 or 3 hours on this stuff, and we'll do it down the road for sure. But just thanks so much for joining us today, and be well and be blessed. Subscribe to Redefine Retirement on YouTube, Spotify, or wherever you listen to podcasts.